Imagine this. It's Monday morning. Markets open. Screens flicker green. Nothing is on fire. No alarms. No breaking news banners. And yet, trillions of dollars quietly depend on a handful of emergency levers staying permanently switched on. Not for crises. Not for recessions. But for normal days. That's the uncomfortable truth most people never hear. Modern financial systems don't just benefit from continuous support. They require it. And the moment that support even hesitates, things don't slowly wobble. They snap. This matters right now because the world isn't recovering from a crisis anymore. It's living inside one that never fully ends. Low growth. High debt. Aging populations. Fragile supply chains. Political pressure everywhere. Yet markets behave as if gravity has been suspended indefinitely. So the real question isn't whether the system needs support. It's why a system this large, this sophisticated, and this expensive can't stand on its own anymore. Let's walk through it. Slowly. Plainly. Without comforting myths. At its core, a financial system does one simple job. It moves money from people who have it to people who need it. At the right time. With some level of trust that it'll come back. That's it. Banks connect savers to borrowers. Markets connect investors to companies. Insurance spreads risk. Payments move value. When that system works, it feels invisible. Boring. Mechanical. But invisibility is misleading. Because underneath, the system is built on promises stacked on top of promises. Your bank deposit isn't sitting in a vault. Your pension isn't a pile of cash. Your insurance policy isn't pre-funded for every disaster. They're all claims. IOUs. Expectations. And expectations are fragile. For most of modern history, those expectations were constrained by something real. Gold. Hard limits. Slow communication. Human friction. Today, the system moves at the speed of code. Trillions of dollars shift in milliseconds. Algorithms trade without emotion. Liquidity appears and disappears instantly. That speed creates efficiency. It also creates instability. Because when confidence breaks now, it doesn't crack. It evaporates. That's where continuous support enters the story. Central banks were originally designed as firefighters. They stepped in during panics. Lent money when no one else would. Stabilized markets temporarily. Then they stepped back. At least, that was the theory. But over time, something changed. Crises stopped being rare. Markets got bigger. Debt got cheaper. Risk migrated into corners no one fully controlled. Every time something threatened to break, intervention worked. So it happened again. And again. Each time, the response got faster. Larger. More creative. Interest rates went down. Asset purchases went up. Emergency tools became permanent features. Eventually, the line between support and normal operations disappeared. Today, the financial system assumes support the way buildings assume gravity. Remove it, and the math doesn't work. Here's the uncomfortable part. The system isn't just supported during stress. It's priced as if support will never be withdrawn. Asset values, housing prices, stock valuations, government debt. They all embed the assumption that money will remain abundant and backstopped. That assumption isn't stated. It's implied. And it shows up in leverage. Cheap money encourages borrowing. Borrowing inflates asset prices. Higher prices justify more borrowing. It feels like growth. But it's growth that only survives if the conditions never tighten. Now let's talk about the math people don't like to say out loud. Debt doesn't just need to be repaid. It needs to be rolled over. Most large debts are never paid off in full. They're refinanced. Extended. Reissued. That works beautifully as long as interest rates stay low and buyers stay confident. But raise rates too much. Or reduce liquidity too fast. And refinancing becomes impossible. That's when defaults cascade. Not slowly. all at once. So policymakers face a choice that isn't really a choice. Tighten conditions and risk systemic failure. Or maintain support and accept distortion. And distortion is the quieter problem. When money is constantly supported, price signals weaken. Risk looks smaller than it is. Bad investments survive longer than they should. Productivity lags while asset prices soar. Capital flows to what benefits most from cheap money, not what creates the most value. Ironically, the system becomes less resilient the more it's protected. Like a muscle that never carries weight. Now here's where the irony deepens. The very tools designed to stabilize markets make markets more sensitive to them. Every word from policymakers moves prices. Every hint of withdrawal causes volatility. Every delay reinforces dependence. Support becomes expectation. Expectation becomes entitlement. Entitlement becomes fragility. And the system grows allergic to uncertainty. This creates a strange psychological loop. Investors don't ask, "Is this sustainable?" They ask, "Will support continue?" If the answer is yes, prices go up. If the answer is unclear, markets panic. If the answer is no, intervention returns. Not because leaders want it to, but because the alternative is worse. Now zoom out. This isn't just about markets. It shapes society. Rising asset prices benefit those who own assets. Wages lag behind. Inequality widens quietly, mathematically, predictably. Savings earn less. Risk-taking feels mandatory. Speculation replaces patience. People feel like they're working inside a system that rewards proximity to capital more than contribution. Trust erodes. And once trust erodes, the system needs even more support to function. That's the feedback loop. Support stabilizes markets. Stability enables leverage. Leverage increases fragility. Fragility demands more support. Round and round. The dangerous part isn't that this is hidden. It's that it's normalized. We now treat extraordinary measures as background noise. Trillions on balance sheets don't shock anyone anymore. Emergency programs quietly persist. Temporary policies become permanent architecture. And each year, the exit gets narrower. Because withdrawing support doesn't return us to the past. It reveals how dependent the present has become. So when people say, "Why don't we just let the system reset?" they're asking the wrong question. A reset isn't a button. It's a collapse of expectations. Contracts repriced. Promises broken. Institutions tested. And no one knows where it stops once it starts. That's why support continues. Not because it's ideal. Not because it's fair. But because the alternative is chaos no one can fully map. Here's the quiet truth. The financial system hasn't failed. It's adapted. But adaptation comes with costs. Less discipline. More distortion. Greater dependence. And a future where stability requires increasingly delicate management. So the real risk isn't inflation. Or bubbles. Or even crashes. The real risk is a system so optimized for intervention that it cannot function without it. A system that survives, but never heals. Which leaves us with one unresolved question. If continuous support is now the price of stability, at what point does support stop stabilizing the system and start becoming the system itself?